Hello and welcome to the Movie Market Podcast. I'm J.R. Gondeck, and as always, joined by David Sokolovsky. David, let's jump into kind of March activity, first quarter overall, and look a little bit ahead to the rest of the year.
Sure. Thanks, JR. So March was another strong month and really capped off a very strong start to the year. If you look at the S&P 500 for the first quarter was up nearly 10%. If you look at small caps, they were up nearly 5%. And then looking at international, up 2, and then even high dividend paying stocks made up some ground from earlier in this year, turning positive. So as you look across the different segments, the economy and the market have performed well. It hasn't been even, so the S&P has been the largest leader, but you've seen the recovery and the continued growth in the other segments, including small cap, international. One area that we've seen a continued weakness is in the broader bond market, and you've seen that it continues to be negative for the year, just based on the long duration that the index holds.
Well, and David, looking a little bit at we talk about the S&P 500 equal weight versus kind of the market cap weight. The last kind of 15, 18 months have been dominated by the largest companies, right? For example, last year, the S&P was up about in a middle 20% range, 24, 25 range. The equal weight was up 11 or 12. So there was a humongous outperformance, and that's continued in the first quarter. But in March alone, you're really starting to see broader participation within the market as well, which is encouraging. Kind of those top 10 names, a number of them are really starting to kind of roll over and not participate fully with the market highs. And again, that's something we've been watching for. You'd probably expect to continue ahead because a lot of that's that chicken and egg, where there's been a lot of growth and recovery in those big companies, but a lot of that's priced in. And looking at the broader performance, it's encouraging with a month like March.
Yeah, Jared, as you look at across the different sectors, so tech is one that we've heard a lot about, and there's been a lot of excitement there. Industrials have also been very strong, but you've seen the recovery in energy and financials as well. So energy, you've seen a recovery in oil prices. Oil prices continue to increase, and that's really helped drive the high dividend paying stock index to turn positive, as well as a number of other companies. And that could prove to be a negative in terms of inflation, because as oil continues to rise, that'll impact the headline number. But outside of that, it's really providing some strength to the economy, and you're seeing the recovery continue.
Well, let's talk about inflation, the Fed, David. When you look at, question is, why was the first quarter as strong as it was, especially after last year kind of seeing the recovery? When you look at inflation, the Fed really wants to get back to 2%. But the reality is they're a long way from actually getting to that kind of 2% number. Powell acknowledged that at the Fed meeting this month. And when you look at CPI, these are the month-by-month numbers. You could see looking ahead, April's a 0.4, August is a 0.5, September is a 0.4. So there's some room to see inflation go down. On the other hand, you have some 0.1s that likely inflation will stay, that middle upper 2 range. And, the commentary from Powell seems to be okay with that at this point, to let inflation be higher than their 2% target and still cut interest rates. So again, that's the thing to watch for as we hit the summer and the rest of the year. Why will the Fed cut interest rates? If it is because inflation is a little bit higher than they want, but the economy is still robust, that'll probably be a good thing for risk assets in the economy overall. If the Fed moves a little more aggressive to cut interest rates because labor market slows down, consumer spending slows down, that could be a reason to get a little more cautious throughout the rest of the year. But these are going to be the things to navigate. But part of that reason, you look at the economy overall, first quarter GDP, we follow the Atlanta Fed pretty closely. Still in a good trajectory with the overall economy. You're looking at 2.8% for first quarter GDP, which is a solid number. And again, taking a step back, really looking pretty simple at the overall market and economy. the GDP remains strong, labor market remains strong, inflation is trending a little bit lower, maybe not as aggressively. And, maybe there's good reason why, the markets and the economy continue to perform very well in the first quarter and looking ahead.
Yeah, Joe, I think as you look at GDP, as you look at the US economy, it is primarily consumer driven. And you saw a little bit of a slowdown in January in consumer spending, but then that just came right back in February, and we'll see the numbers for March as well. But you've seen a lot of economic activity, and again, some of that may have been pulled forward a little bit in the fourth quarter of last year, but then you've seen that continued economic activity. And one thing that you've noticed is the economic activity has been somewhat uneven. So as you look at earnings, there's opportunities in some of the segments, and you've seen some companies have struggled with their earnings because as consumer spending habits change, and as people look to where they want to prioritize their dollars, there is starting to be a little bit of a shift.
Well, let's look at that, David. When you think about broadly, how much income consumers are making, right? Overall, as you have here, looking at personal income over the last couple of years, it went from just under 12.5 trillion to over 14 trillion. So you're up over 2 trillion of extra income for a bunch of reasons. Number one, more people are working. So adding to the labor force has grown the overall income. Number two, the people that continue to work are getting their wage inflation adjustments, and that's grown the national income. So, from the overall perspective, you can see the consumer steady. On the other hand, if you look at maybe middle America adjusted inflation, I think you see a little bit of the challenge.
Well, and Joe, I think this kind of points it out. So this is per capita disposable income, right? And so what you've seen is, once you take out the expenses that are required, you've seen really just a big drop in the disposable income, and really just this is primarily driven by inflation. So inflation has really eroded some of the purchasing power, and you saw that the peak inflation was in the second quarter of 2022. Now, as inflation has continued to ease, you've seen that personal disposable income continue to go up, and not necessarily the same pace that maybe you saw the initial recovery, but you can continue to see it go higher and higher. And so what that does is opens up the ability for consumers to spend and to continue to drive the economy forward. So as these numbers continue to evolve, we'll see if the wage inflation that we're seeing and the wage increases continue to outpace the increase in cost of goods and services. And if that continues to be the trend, you're going to start to see a lot more demand and continue to really drive the economy. But like you said, there really aren't many signs of, or really strong signs of slowing spending or slowing economy, because as you pointed out, 2.8% for the largest economy in the world is a significant growth trajectory. So you've seen a lot of economic activity to start the year. And again, as we keep talking about the recession that is potentially out there at some point in the future, there's a 100% chance of one eventually coming, but it keeps getting moved out quarter after quarter because companies have been able to adjust they've been able to adjust to the higher interest rates. Consumers have been able to adjust. They've picked the areas where they want to invest, and you continue to see economic activity move higher.
Well, when you take a step back and analyze a little bit more the income overall, right? We're up over 2 trillion. So that's going to drive things, ahead. And they're not likely to slow down based on the continued job growth at this point and consistent 4 to 4.5% wage inflation, which is a healthy number. But when you think about the impact, on the one hand, the median income is flat over 3 years. It's picked up since peak inflation. The reality is there's still a lot of struggle within kind of the middle class on inflation. So as you look to allocate and see which companies do well, you're likely to see a lot of substituting or shifting, expenses. Maybe you trade down instead of going to the restaurant, or, you switch between, what you're buying overall, and that's going to impact, which companies do well. On the other hand, when you look at upper incomes, even though inflation's impacted everybody, the proportional increase in wages at the, upper end, hasn't been as impacted. So you're likely to continue to see a lot of benefits in the higher income spending trends and those things. But again, to us, it's somewhat of a normalized economy where there's going to be winners and I wouldn't say losers, but businesses that aren't doing nearly as well based on consumer shifts over the next few quarters. And again, look at the outlook. You start to see corporate earnings come out next Friday. And again, first quarter results should be solid based on everything we're seeing. But as always, we're going to be looking for what do companies say about the future. Where are consumers at this cycle? Where are they spending? And that's where you're going to want to allocate your portfolio overall is to the consistent, healthy trends that you're seeing in the economy and reduce, where consumers are, where, there might be some overvalued parts of the stock market at this point. So looking ahead, as always, where do you go, right? And I think, thinking about the start of the year, in a lot of ways, the first quarter is almost an entire year's worth of gains, right? On the other hand, looking at the economic trends, there still is a lot of value within the market. And the other hand, just being mindful of rebalancing, looking at some of your positions in your portfolio that have done a lot better than others. It's okay to pay some taxes and rebalance and look to that. And I think you're going to continue to see investors do a lot of that. And the other side is if you're a little bit nervous or you're sitting on cash, interest rates are higher and they're going to stay a little bit higher for longer. The bond market hasn't performed, much of anything to start the year because interest rates have moved up. On the other hand, as you're looking to lock in some income, rebalance your portfolio, the bond market offers really, really good value at this point between now and the end of the year. So with that,
I was going to say, I think with the bond market, the opportunity is there to lock in the rates. And as you see some of that fluctuation with interest rates, and again, as I pointed out, the bond market is slightly negative to start the year, but that is the price movement. The thing that you get there is the consistency and the safety to have a predictable income stream. And so as you look to rebalance and de-risk portfolios, especially as you approach retirement or as you approach an important life change that requires income, it's a good opportunity to lock in some of the gains, shift some of that to income and have a predictable income stream that even if rates fluctuate a little bit, will continue to pay a consistent interest payment.
Well, and you look, we talked about this last month, the momentum markets are very difficult to invest in where you're really looking at maybe 5 to 10 years growth in some of these areas priced in today. And again, it's just a reminder, it's okay to take some profit, pay taxes. April 15th is coming up, right? You build that into your cash flow and projections overall and keep a consistent balance because the challenge, it's nice when momentum markets are going up. On the other hand, when they fall, you want to be protected. And again, taking a little bit of profit along the way, being consistent, diversified, rebalance, lock in some of those, extra income opportunities that are out there today will pay dividends, so to speak, as the markets fall and in the future. But meanwhile, at this point, the overall economy looks in solid footing. The Fed is watching and very, very data dependent on when they cut rates. But meanwhile, looking at the first quarter and outlook, you feel pretty good about where things are until they change, right? And that's where we're all looking for. What is going to be the trigger point and change? Corporate earnings will be definitely something to watch over the next few weeks. And with that, I'm going to thank you for tuning in, and we'll touch base and kind of recap, earnings over the April and look ahead to the summer.
Thanks.